It's often said that the U.S. economy is still growing. That GDP isn't in recession, the labor market is still healthy, and stocks continue to reach new highs. These numbers appear frequently in headlines, reports, and policy messages. But if the economy is truly stable, why are more and more American families running out of cash? This isn't just on the charts. It's in the lives of the middle class, of service workers, of young families carefully considering every small expense. When millions simultaneously postpone purchases, drain savings, and use credit cards to cover living expenses, it's no longer a personal choice. It's a systemic signal. In this video, we'll trace a growing paradox in 2026. The economy is described as not in recession, but people's economic sentiment is rapidly deteriorating. 3 initial signs suggest the story behind the numbers isn't pleasant. First, growth exists, but real incomes aren't keeping pace with the cost of living. As housing, healthcare, insurance, and essential services prices escalate, nominal wage increases aren't enough to offset the cost. The gap isn't noisy, but it erodes month by month. Second, household debt has become a lifeline. Credit cards, short-term consumer loans, buy now pay later tools once conveniences are now being used as a means of survival. When debt no longer serves optional consumption but becomes mandatory spending, the nature of risk has changed. Third, defensive saving replaces confident consumption. People are spending relentlessly out of optimism. They spend because they have no other choice, while major decisions, buying a house, having children, investing in education, are constantly postponed. It's a mass behavioral shift, and it often precedes economic turning points. The surface numbers may tell a plausible story, but when placed side by side, these indicators tell a different story: an economy that operates well on paper, while real life is constrained by costs, debt, and uncertainty. The numbers may continue to tell their story, but as life increasingly diverges from what is being reported, that gap is no longer a technical detail. It becomes the starting point of a whole new problem brewing beneath the surface of growth. On the surface, the U.S. economy in 2026 is being portrayed with a familiar and compelling narrative. Composite indicators suggest growth persists. GDP is not in a prolonged technical recession. Unemployment is reported at historically low levels compared to previous periods. The stock market, after corrections, remains in high valuations. For many observers, this is evidence of an economy that withstands interest rate shocks and global instability. When output doesn't plummet, when employment is maintained, and when asset markets don't collapse, the economy is considered to be functioning normally. Within that framework, negative fluctuations are seen as localized, temporary, or the price paid for controlling inflation. Soft landing becomes the central phrase, implying that the economy has avoided the worst-case scenario. Mainstream media reinforces this narrative with familiar highlights. Nominal growth is juxtaposed with employment figures to demonstrate resilience. Large corporate earnings reports show the ability to pass costs on to consumers. Financial market flows are interpreted as signals of confidence. In this picture, consumer fluctuations are explained by cautious sentiment rather than structural pressures. This framing isn't entirely wrong. The indicators used are all valid in macroeconomic analysis. GDP measures total output, unemployment reflects the level of employment, the stock market aggregates expectations of future returns. When these measures don't signal a crisis, the conclusion that the economy is fine sounds reasonable. But the issue isn't whether these indicators are right or wrong. The issue is what they measure and what they don't measure. GDP may be growing while much of the value added is concentrated in a few sectors or groups of businesses. Low unemployment may coexist with precarious employment, volatile working hours, and weakening real wages. The stock market may reflect investor expectations, but not the affordability of rent or medical bills for households. In the current framework, those pressures are often pushed out of the picture. When the economy is assessed primarily through aggregate indicators, living experience becomes secondary data. Rising living costs are seen as a lag factor. Household debt is seen as a consequence of consumer choice. Population contraction is explained by psychology, not structure. The analytical language therefore tends to downplay risk, adjustment, rebalancing, adaptation. Also within this surface picture, policy is presented as being in a difficult but manageable equilibrium. High interest rates are presented as necessary to curb inflation, with the assumption that the negative impact will gradually be absorbed. Fiscal deficits are constrained by the deficit, but seen as a long-term problem. The focus remains on stabilizing major indicators because that is what is measured most frequently and provides the quickest feedback. It is noteworthy how the surface picture handles contradictions. When conflicting data emerges, for example, weakening consumption in certain groups, or rapidly rising debt, they are often treated separately, not linked together. Each issue is seen as a separate data point, rather than a symptom of the same underlying pressure. This approach diminishes the sense of urgency and makes it difficult to recognize the cumulative risks. There's a small crack in the mainstream narrative, the increasingly frequent acknowledgement that people's economic sentiment doesn't match the data. But this acknowledgement often stops at descriptive levels, not going any further. It's seen as a communication problem, not a signal that the measures are missing something important. It is at this intersection between the rational macroeconomic picture and negative social sentiment, and precisely where the indicators continue to function smoothly while the living experience begins to strain, that a silent divergence is created. That disparity isn't immediately apparent in the reports, but it's clearly present in everyday life. Because when aggregate indicators no longer reflect real-life experiences, the gap between stability and insecurity isn't just an emotional issue. It's a sign of a systemic imbalance. Moving away from aggregate reports and down to the household level, the picture changes dramatically. Here, the economy isn't perceived through an upward curve, but through increasingly frantic financial breathing. Nominal income may be rising, but real income after deducting living expenses is under sustained pressure. This disparity doesn't appear as a single shock, it accumulates, month after month, until it becomes a feeling of exhaustion. Housing costs are the clearest example. Rent and home ownership costs continue to be pegged high relative to income, especially in job-intensive urban areas. Even without a dramatic price surge, the new cost structure is enough to maintain constant pressure. For many families, housing is no longer a potentially manageable expense, it becomes a fixed hidden tax, forcing other expenses to shrink. Healthcare and insurance are a second layer of pressure. Insurance premiums, medical expenses, and co-payments are rising faster than the real income of many working groups. These costs are difficult to postpone, and so they are financed by cutting other consumption or using credit. Education from tuition to student loans continues to lock down young people's future cash flow, even after they start working. In this context, household debt shifts its role. Credit cards, short-term consumer loans, and buy now pay later arrangements are no longer just utilities, they become tools to offset shortfalls. When mandatory spending is financed by debt, the risk is no longer in the possibility of overspending, but in the fragility of cash flow. Prolonged high interest rates are making this cycle increasingly expensive. People's financial behavior reflects this shift. Defensive saving is replacing confident consumption. Many households are gradually depleting reserves, delaying major decisions, and prioritizing liquidity over long-term benefits. Working overtime, juggling multiple jobs, or participating in the gig economy is not driven by opportunity, but by necessity. When these behaviors appear simultaneously, they become systemic signals, no longer individual stories. Social cross-sections reveal this disparity is widespread. The middle class, often considered the pillar of stability, feels the pressure most acutely as fixed costs erode financial space. Young people face a double whammy: low starting income while housing costs and education debt are high. Long-term renters face the risk of price adjustments, while the opportunity to own property becomes increasingly distant. Service workers, even those with jobs, face uncertainty regarding working hours and benefits. A noteworthy point is the emotional paradox. Data may show that consumption hasn't collapsed, but that doesn't equate to reassurance. Many expenses continue because they can't be cut: housing, healthcare, transportation, while options are shrinking. The result is an economy where money still flows, but confidence is gone. People are spending defensively, not expectantly. The difference between spending out of need and spending out of desire is crucial. Aggregate statistics struggle to distinguish these two dynamics, but life feels it very clearly. When the majority of money is spent maintaining the status quo, not improving the future, the foundation for growth becomes fragile. At the macro level, this divergence is often explained by psychology that people are more pessimistic than necessary. But at the micro level, defensive financial decisions reveal a different logic, a rational response to structural pressures. When real incomes erode and fixed costs escalate, caution isn't an emotion, it's a survival strategy. When these defensive behaviors are repeated on a large scale, they no longer reflect individual choices. They reflect pressure created by how the system is operating, where costs are escalating faster than the majority can adapt. To understand why financial pressure is surging across households, one must move beyond the surface manifestations and look at the underlying mechanisms. This isn't a story of a single policy decision or a short-term shock. It's the result of many overlapping links, with a lag long enough to cause official indicators to react more slowly than real life. The first link is the prolonged high interest rate environment. Monetary tightening aimed at curbing inflation is designed to slow demand, but its impact isn't evenly distributed. Large businesses and asset-rich groups benefit from high interest rates on deposits and access to preferential credit. Meanwhile, households dependent on short-term credit cards, consumer loans bear immediate costs. When interest rates remain high for extended periods, the cost of living increases even when commodity prices stabilize. The policy lag thus creates a paradox. Inflation, measured in terms of cooling, is subsiding, but financial pressures on daily life are increasing. The second link is the financialization of essential costs. Housing, healthcare, education, basic needs are increasingly functioning as financial assets. Their prices reflect not only physical supply and demand, but also expectations of returns, capital flows, and market structure. As housing becomes a channel for asset accumulation and healthcare becomes a high-margin industry, costs for end users rise faster than income. These expenditures are like hidden taxes, not collected by the state, but forced upon citizens regularly, with little room for negotiation. The third link lies in the structure of the labor market. Low unemployment rates mask the growing fragmentation between different types of jobs. Stable full-time employment with full benefits is no longer the universal norm. Many new positions are concentrated in the service sector, short-term contracts, or the gig economy where income is volatile and insurance costs are passed on to workers. In this context, job growth does not equate to increased financial security. The figures reflect quantity, but miss the quality. The fourth link is the distribution of the benefits of growth. As corporate profits increase due to the ability to pass costs on to consumers, value added is concentrated in shareholders and the capital group. The stock market reflects this expectation, but labor income increases more slowly. The disparity doesn't explode immediately, it accumulates. In the short term, the economy is still functioning. In the long term, households' ability to absorb shocks is weakening. One often overlooked factor is statistical lag. Many macroeconomic indicators are designed to confirm trends already occurring, not to warn of emerging pressures. GDP aggregates past output. Unemployment reflects current employment status, but does not measure the level of financial stress on those employed. When households begin using debt to sustain spending, the impact on growth may be delayed, but when it does appear, the room for adjustment has narrowed. The role of expectations also needs to be considered. When people believe costs will remain high and job losses increase, they adjust their behavior defensively. Consumption is suppressed, not because of a lack of demand, but because of a lack of confidence in future stability. These decisions, when widespread, create their own drag on growth, a feedback loop that is difficult to reverse. These mechanisms are interconnected in a chain. High interest rates increase the cost of debt. Financialized essential costs reduce the room for spending. A fragmented labor market leads to unstable incomes. Concentrated growth benefits weaken the resilience of the masses. And statistical lags delay warnings. None of these links alone is enough to create an immediate crisis, but combined, they create a synergistic pressure, something people feel before the data reflects. The key is how these mechanisms are normalized. When pressure builds gradually, society tends to adapt rather than react. Borrowing more, working overtime, delaying decisions, these adjustments keep the system running, but the cost is paid gradually. Risk doesn't disappear, it's carried forward. And when the accumulated pressure is large enough, the impact doesn't stop at the household. It spills over to small businesses dependent on local consumption, to communities where incomes are compressed, and ultimately back into the financial system through credit and trust. That is why the current signs need to be seen not as isolated phenomena, but as the beginning of a ripple effect. When these mechanisms overlap and operate for a sufficient period, the impact is no longer confined to individual households. Pressure begins to spread to other levels of the economy, along paths rarely seen in the headlines. When financial pressure accumulates at the household level, it doesn't stand still. From small, defensive decisions cutting spending, delaying purchases, turning over credit, a ripple effect begins to form. This chain goes from consumers to small businesses, from local communities to the credit channel, and finally back to the financial system in the form of confidence risk. Small businesses are the first point of contact. Unlike large corporations that have the ability to pass costs and access cheaper capital, local businesses depend directly on everyday purchasing power. When people shift to defensive consumption, revenues don't collapse immediately, but profit margins are compressed. Business owners respond by delaying investment, cutting hours, or not expanding hiring. These decisions rarely make headlines, but they undermine employment momentum within communities. At the local level, this pressure amplifies. Compressed incomes lead to reduced tax revenues, while demand for social services increases. Communities with high rental rates are hit harder as housing costs erode other consumption. The weakening isn't uniform, it's concentrated in already fragile areas, exacerbating regional disparities. The credit channel is where the pressure returns to the financial system. As households use debt to sustain spending, credit quality deteriorates over time. Delay rates may rise slowly, but the trend is noticeable. Lenders respond by tightening standards, making credit more expensive and harder to access, a feedback loop that further increases pressure at the borrower level. In this picture, there are groups that are almost invisible in aggregate statistics. Long-term renters face price adjustments without matching assets. Gig and short-term contract workers have jobs but lack income and benefits stability. Older adults with insufficient savings face the double impact of medical costs and interest rates. Families burdened with large education debts must prioritize debt repayment over accumulation. These groups rarely appear in growth reports, but they are where the pressure is most concentrated. The long-term risk lies in the erosion of the social foundation. When consumption is sustained by debt, when personal investment is postponed, and when confidence in the ability to improve one's life weakens, future growth becomes fragile. This is not an immediate risk, and therefore it is often downplayed. But history shows that prolonged periods of stability on paper often end in sharp corrections when confidence runs out. Another often overlooked factor is the ripple effect of psychological impact. Financial insecurity doesn't just affect spending, it shapes expectations. People become risk-averse, delaying long-term decisions like buying a home or investing in education. Businesses become more cautious about expansion. When both sides are on the defensive, growth momentum weakens even without an obvious shock. Short-term media struggle to capture these processes because they lack a moment of explosive change. There's no single event to headline. But it's this quiet accumulation that's key. It explains why macroeconomic indicators might look stable while social life becomes more strained each quarter. What makes the picture worrying isn't an immediate collapse scenario, but the system's ability to underestimate the accumulated risk. When the groups most under pressure aren't seen, policy responses tend to be delayed or misdirected. And when responses are delayed, the social cost is often far greater than what the initial data suggests. All these ripple effects converge on one common point: confidence. Not confidence in the financial markets, but people's confidence in the economic system's ability to serve the masses. When this confidence weakens, defensive behaviors become the norm and they shape the economy's next trajectory. This leads to, when prolonged financial pressure remains unaddressed, the most profound change isn't in the indicators, but in confidence. Confidence here isn't abstract, it's a weighty economic variable. It determines whether people dare to spend, businesses dare to invest, and society dares to take risks to move forward. In the current context, confidence is shifting towards a defensive direction. People no longer believe that individual effort is sufficient to improve their financial standing. Economic decisions are therefore delayed, delaying home purchases, delaying childbirth, delaying investment in education, delaying business expansion. Each individual decision is reasonable in the short term, but when they occur collectively, they create drag on long-term growth. A crisis of confidence is different from a cyclical recession. It doesn't erupt in a single quarter, nor does it end with a single stimulus package. It spreads slowly, deeply embedded in expectations. When people believe the system no longer distributes opportunities fairly, they adjust their behavior toward preservation rather than expansion. This alters the structure of consumption, labor, and investment, the foundations of sustainable growth. It's noteworthy that there's a disconnect between market signals and societal perceptions. Financial markets can react quickly to policy and profit expectations, but life takes time to recover. When this gap widens, the message "the economy is fine" loses its persuasiveness. This isn't because people lack understanding, but because their life experiences contradict that assertion. The crisis of confidence also shapes how society views the future. Risk-taking sentiment weakens, while defensive attitudes become the norm. This affects not only consumption, but also innovation and productivity. An economy where most resources are used to maintain the status quo will struggle to generate new growth momentum. There are no simple answers to this situation. Lowering interest rates or making single policy adjustments might alleviate some of the pressure, but they don't address the root cause of the discrepancy between data and reality. Systemic solutions, from measuring economic well-being to allocating essential spending, require time and political consensus. In the transition period, uncertainty remains a prominent feature. It is crucial to avoid two extremes. On the one hand, false reassurance erodes confidence when living conditions do not improve. On the other hand, predictions of absolute collapse ignore the system's ability to adapt. The reality lies in the middle ground. The economy continues to function, but the social cost is increasing, and the cumulative risk cannot be ignored. And when confidence becomes the most fragile variable, the economy can still function but at an increasingly higher cost to the majority. This doesn't appear in a quarter, but is gradually imprinted on how society views the future.